All right, today we're giving the global markets a full-on health check. We're going to take a snapshot of the world's economic pulse using the very latest data. Let's dive right in.
So I want you to just imagine something for a moment. What if you could actually see the financial heartbeat of every single major economy all at once, just moving and changing, every single second? Yeah, it would probably look a whole lot like this, just a chaotic sea of red and green numbers that, let's be honest, can feel completely overwhelming. But hey, don't worry, that's exactly what we're here to do. Cut through all that noise and make some sense of what it all really means. So, first things first, let's start with the big picture. You can think of this part as the initial checkup, where we look at the overall vital signs just to get a general sense of the market's health. Now, what's really fascinating here is the story these numbers are telling us. These indices, they're basically scorecards for their country's stock markets. The S&P 500 and the NASDAQ, they're showing some really robust health in the US. But then you look over at Japan's Nikkei 225, wow, an incredible 50% jump. Meanwhile, Germany's DAX is showing much more modest growth. So it's kind of a mixed bag, but the overall trend is definitely pointing up. Okay, now let's just focus on this one single number for a second, 69.36%. So, what is this? Well, that's the year-to-date performance of the S&P 500 VIX. You might have heard it called the market's fear index. A high number like this, it doesn't measure stock prices. Nope, it measures volatility and uncertainty. So the key takeaway here is that while stocks have gone up, the ride to get there has been, well, a whole lot bumpier. All right, so let's dig into that idea of volatility a bit more. We're moving from the high-level vitals down to the individual patients, so to speak. The companies that are either absolutely thriving or really struggling in this environment. And this just perfectly captures that contrast. You've got two massive, well-known tech companies here. On one side, NVIDIA has been riding this incredible wave, up over 60% in just a year, and on the other, there's Adobe, which is down nearly 40% in that exact same time. It just goes to show you how even within a single hot sector, the market is constantly picking very specific winners and losers. But a one-year snapshot, it never really tells the full story, does it? If we zoom out and look at a 3-year view, the numbers become absolutely staggering. Look at these returns. NVIDIA, again with nearly 700% growth. And Robinhood Markets, despite all its recent volatility, has seen over 750% growth in 3 years. It really drives home the power of looking at the bigger, long-term picture. All right, let's shift gears. If stocks are the organs of the economy, then you can think of commodities and currencies as the bloodstream, carrying value and resources to every single part. And just like blood pressure, their value is constantly in flux. This is where the global market starts to really hit home for most of us. Just look at crude oil, up nearly 50% this year alone. That's what you're feeling every time you fill up your car. U.S. wheat is up over 18%. That's the price of bread at the grocery store. And even gold, the classic safe haven asset, is up almost 17%, which tells us investors are definitely looking for stability. And get this, it's not just the stuff we buy that's changing in price. The actual money we use to buy them is changing in value too. You can see right here how major currencies have been performing against each other. For instance, the US dollar has gotten a lot stronger against the Japanese yen, which has huge implications for everything from trade to travel between those two countries.
Okay, for our final deep dive, we're going to look at what's really the bedrock of the entire financial system, and that's bonds. This is how we can gauge long-term confidence and stability in an economy.
But before we get into the weeds, let's just quickly get on the same page with a key term, bond yield. Put simply, it's just the return you get for loaning your money, usually to a government. Think of it as an interest rate. So if that yield is going up, it basically means investors are demanding a higher interest rate to lend out their money, often because they see more risk on the horizon. And this is what that data looks like out in the wild. It's rows and rows of numbers. I know, but now you know exactly what to look for. That yield column, that is the crucial piece of information. It's the market's real-time vote of confidence, or lack thereof, in a country's ability to pay back its debts. Okay, so this all seems pretty abstract, right? A bunch of numbers on government debt. Which brings us to the most important question of all. Why on earth should you care what the yield is on some 10-year government bond? And here's the punchline. Because that one number, the government bond yield, it basically sets the baseline interest rate for the entire economy. It directly influences the interest rates you'll pay on your mortgage, on your car loan, on your credit card. When that number moves, the cost of borrowing money in your own life moves right along with it.
So what's our final diagnosis from this global health check? Well, it's definitely a market of sharp contrasts. We're seeing strong stock performance, but it's happening alongside some really high volatility. The price of essential things like energy is surging, and the very bedrock of the system, the bond market, is signaling that long-term stability is shifting under our feet.
So there you have it. That's the pulse of the market, at least for today. But this is all just a snapshot in time. And with every single piece of this data changing every single second, it leaves us with the one question that really truly matters. What happens tomorrow?